In market news now, European and Asian stocks fell after China cut interest rates by less than expected, and the market awaited more details on Beijing's plans to shore up a stuttering economic recovery. Overnight, the People's Bank of China trimmed its lending rates by just 10 basis points, fueling concern about the prospects of a rebound in the world's second biggest economy after authorities lifted a strict zero-COVID policy. Meanwhile, market participants await further direction from a Capitol Hill testimony by U.S. Federal Chair Jerome Powell this week. To talk to us about the latest when it comes to the markets, we are joined by Lukman Otsunuga from FXTM. Lukman, thank you so much for your time. So let's discuss that market sentiment following Wednesday's Fed press conference, as well as the lead up to this testimony over the next 2 days.
Thank you for having me here today. Yeah, market sentiment has been somewhat shaky as investors try to piece together the Fed riddle, the Fed puzzle. You know, we've got some conflicting statements on some uncertainty. On top of that, concerns over China's economic outlook and the lack of fresh stimulus from Beijing seems to keep market and investors on edge. If you look at FX and commodity markets, I think a lot of these instruments are trapped within a range and waiting for the next fresh directional catalyst.
So do the markets believe Jerome Powell?
Jerome Powell said a lot of things. He said that he expects the July meeting to be live. You know, the Fed showed that they expect 2 more rate hikes in 2023. And he said that rate cuts are a couple of years out. I think ultimately there seems to be a disconnect between the Fed and the markets. The Fed did say something very important, data dependency. And I think moving forward, I think markets are going to be looking more closely to economic data to see whether it aligns with what the Fed is saying.
Speaking of economic data, a couple of months ago, all we spoke about was U.S. recession fears or the possibility of a hard landing. Where are we when it comes to those fears?
I remember those talks many months back, and it looks like, you know, the U.S. economy is experiencing some sort of change of fortune. You know, it's showing more signs of strength than weaknesses. All you need to look at the latest U.S. jobs report, which exceeded market expectations. U.S. retail sales unexpectedly rose in May. Okay, there's some weakness in the manufacturing sector, but there's more good than bad. And I think moving forward, though, as data continues to show more resilience in the U.S. economy, this may support market expectations around rate hikes being higher for longer. But I think one thing we need to keep a close eye on is the S&P Global Manufacturing PMI on Friday, which could give fresh insight into where the U.S. economy is going.
So if Fed Chair Jerome Powell is saying that cuts are a couple of years away, what's your baseline view of those Fed cuts? What does the timeline look like?
Interestingly, you know, when we're looking at the Fed futures and everything, most, including myself, are expecting a rate cut by the end of Q4, you know, sometime in Q4. But again, due to the fact that U.S. economic data continues to beat, you know, this is giving the room for Fed hawks to act more. However, though, one thing we need to keep in mind is that inflation in the United States has actually declined to 4% in May, which has actually been the lowest since March 2021. So signs of cooling inflationary pressures in the United States could support the argument over, you know, the Fed's hiking campaign coming to an end. But then we're going back to what we said again, everything's all about data dependency. You know, more strong data will support expectations around higher rates, but, you know, more signs of easing inflation and disappointing data could bring back those bets of a rate cut in 2023.
You're currently in the UK, so what's the UK inflation picture, given that we are expecting CPI data tomorrow and then the following day the Bank of England's interest rate announcement?
Certainly, it's a terrible picture here in the UK. Okay, so even though UK inflation is no longer double digits, it's still more than 4 times the Bank of England's 2% target. Yeah, tomorrow we have UK inflation is expected to cool to 8.4% in May compared to April, but still, you know, that's still very high. And given this should still support expectations around the Bank of England raising interest rates by 25 basis points this month. In fact, the Bank of England is actually expected to raise rates another 5 to 6 times in 2023. Bringing the interest rate to 6% in an effort to fight inflation. Would this become a reality? Time will tell.
If it does become a reality in the next couple of months that we see rates going to 6%, what does that mean for Rishi Sunak's plan to grow the economy? There are talks that GDP could drop by 2%.
Absolutely. This morning, the Bank of England has actually recently warned that if interest rates is at 6%, it could tip the UK economy in a recession. And, when we look at Economics 101, higher interest rates, lead to higher mortgage repayments. This results in lower disposable income. If consumer spending falls, and at the same time, if this impacts business investment, this is going to feed back to GDP. We know consumption is an engine of growth for the UK economy. So ultimately, even though the Bank of England is in a quest to try to tame inflationary pressures by raising interest rates, if rates remain too high for too long, this will negatively impact the UK economy. So this could, pour cold water on Rishi Sunak's target for growing the UK economy if nothing changes.
As we wrap up, what other events are you keeping an eye on for the rest of the week?
Absolutely. I've got my eyes peeled on Jerome Powell's semi-annual congressional testimony on Wednesday and Thursday. It could be a big deal. Yeah, Powell is widely expected to reiterate his post-Fed meeting statement, saying some caution and opening doors to more rate hikes down the line. But if he drops a surprise or if he's more hawkish than expected, this could send shockwaves across the market. So I'll be looking at how the dollar, the S&P 500 and gold reacts to this high-risk event.
Lukman, thank you so much for your time. That is Lukman Otunuga from FXTM giving us his perspective on the markets. That is it for me. We're going to take a quick break. When we come back, we'll have more news for you, so stay tuned.